Every share you've ever bought through an app sent the company $0. Not a reduced amount, zero. The money went to whoever sold it to you, and the company whose name is on the stock wasn't part of the transaction at all. And there are two more markets past those two that almost nobody can name, which is exactly why the exam likes asking. This is section 1 again, and market structure is where a chunk of those 12 scored items live. The good news is that all 4 markets fall out of a single question.
Erica here. And that single question is who is on the selling side.
Kay here. If the issuer itself is selling, you're in the primary market. The company is handing over newly created shares and taking in cash.
Which is what an initial public offering is. The SEC puts it plainly. An IPO has historically referred to the first time a company offers its shares of capital stock to the general public.
And that's the moment the company raises money. That's the whole point of the exercise from the issuer's side.
Then everything afterwards is the secondary market. You buy from another investor who already owns it. The shares change hands and the issuer isn't a party to it.
And the primary market is wider than just the first time. A company that has already been public for 20 years can issue brand new shares tomorrow, and that's still a primary transaction because the issuer is the one selling. First offering and primary market aren't synonyms, and a question can be built on exactly that overlap.
The same bulletin describes exactly that path. The more common way for an individual investor is to purchase the shares when they're resold in the public market in the days following the IPO.
Resold, that one word is the whole distinction. New issue versus resale.
So when a question says a customer bought 200 shares of a listed company through their broker, that's secondary every time, unless the question works hard to tell you otherwise. It's worth being concrete about where the money physically goes because that's what makes it stick. In an IPO, the cash from the shares sold reaches the issuing company, net of what the underwriters take. In a resale on any ordinary Tuesday, the cash reaches whoever sold you the shares. The company's bank balance doesn't move by a cent.
Which raises something Kai and I disagreed about before we started, and it's worth putting to somebody who studies this.
We did. If the company gets nothing, why would an issuer care what its stock does on a Tuesday?
Let me pause for just a second because this genuinely helps. If you are getting value here, hit that like button, then subscribe and ring the bell. It costs you nothing, and it is the single biggest thing that keeps these videos coming. Kay asked why an issuer should care about a market it gets no money from. It's a genuinely good question, and the answer isn't obvious.
It deserves someone who works on how issuers and markets actually interact.
Professor Castillo studies how companies finance themselves through public markets, and flagged Kai's exact objection to me beforehand.
Kai is right that no cash reaches the issuer on a Tuesday. But the price set on that Tuesday is the price the company will issue at the next time it needs money, and most companies come back to the market more than once.
So today's secondary price is tomorrow's primary price.
It's the reference point for it, and it's the currency for acquisitions because a company buying another with its own stock is spending something the secondary market valued. It also prices every share of employee equity, which is how a great many firms pay people.
And there's a version of this that matters to the viewer rather than the exam. If you own a stock, the only way you ever see a return is a dividend or another investor paying you more than you paid. Both of those run through the market that sends the company nothing, which is a strange thing to sit with for a moment.
And the bulletin we quoted earlier hints at this from the other end.
It says an IPO helps to establish a trading market for the company's shares, and that's worth reading carefully. Establishing the trading market is listed as a benefit of going public alongside the money.
Because without one, nobody would buy the issue in the first place.
That's the circular part, and it's the answer to Kai. An investor buying a new issue is buying on the assumption they can sell it later to somebody else. Remove the secondary market and the primary market can't function because nobody would commit money they could never get back out.
So the market that pays the issuer nothing is what makes the market that pays it everything possible.
Precisely. They aren't two separate things that happen to share a name. One is the reason the other works.
Does any of that matter for answering a question, or is it just context?
It matters because it stops you guessing. Once you understand that primary means the issuer is raising money, you'll never mislabel a resale, and you won't be tempted by an answer choice that has the company collecting cash from an ordinary trade.
Professor Castillo, thank you. One being the reason the other works is a much better hook than two definitions side by side.
Kai asked the question that made it worth explaining. Don't let a definition sit there unquestioned.
Now the two nobody names. Third market and fourth market, and the names are useless because they tell you nothing about what they're.
This is the pair I flagged at the top, and they're worth 10 minutes because they're cheap points once they click.
Third market is exchange-listed securities being traded over the counter, away from the exchange the stock is listed on.
So the stock is listed. It could trade on the exchange. It just isn't doing so for that particular trade.
And the word that trips people is listed. People hear over the counter and assume the security must be an unlisted one. In the third market, the security is listed and the venue isn't the exchange.
Fourth market is different again. That's institution trading directly with institution, without a broker-dealer intermediating.
And there's a reason a large trade would want to be off the exchange at all, which makes the third market less arbitrary than the name suggests. A big order landing on an exchange moves the price against the person placing it. Negotiating it away from the exchange can get the whole block done at one price instead of walking it up.
Two large funds moving a block between themselves. No exchange, no broker taking the other side, no commission in the middle.
And these days, a lot of that runs through electronic networks built for exactly that purpose, which is why the fourth market gets described as electronic more often than it used to be.
Here's the part that catches people, though. Both of those are still secondary market activity.
Which is worth saying twice. Third and fourth aren't a separate category from primary and secondary. They're descriptions of where secondary trading happens.
So if a question asks whether a fourth market trade raises capital for the issuer, the answer is no, for exactly the same reason as any other resale.
So does a fourth market trade raise capital for the issuer? People assume the exotic-sounding ones must work differently, and they don't.
The same logic drives the fourth market, only further. Two institutions who already know they want opposite sides of the same block have no need of an intermediary to find each other. Cutting the broker out removes a cost and, just as importantly, removes anybody else who would learn what they're doing before it's done.
The issuer is still not in the room.
Which means the four markets are really two questions, not four facts, and that's the shape worth carrying into the exam.
So let's turn four definitions into the two questions Erica just described, because that's what you can actually run under time pressure.
And this is where it stops being memorization.
Professor Castillo is back with us for this.
Question 1 is the only one that matters most of the time. Is the issuer on the selling side of this transaction? If yes, it's primary and the company is raising money. If no, it's secondary and the company is a spectator.
And that one question handles most items?
And it's worth noticing that the first question does real work even when a scenario is deliberately cluttered. A question can name an exchange, a broker, a price, and a settlement date, and none of that changes the answer. Only one detail matters, which is whether the issuer was the one selling.
It handles anything about proceeds, about new issues, about who receives the cash, which is a large share of what gets asked, because it's the distinction with real consequences behind it.
And question 2 only comes up once you already know it's secondary.
Only then, and it asks where. On the exchange, the security is listed on, that's ordinary exchange trading. Listed security, traded off that exchange, third market. Institution straight to institution with no broker-dealer in between, fourth market.
Is there a fast tell for the third and fourth in the wording of a question?
Look for who the parties are. If a question names two institutions and no intermediary, it has already told you fourth market. If it says a listed security traded over the counter, that phrase is the third market by definition, and there's nothing else to work out.
And the honest limit on all of this?
That the numbered names are industry shorthand rather than precise legal categories, and the market has changed a great deal since they were coined. Don't go looking for a crisp boundary that's not there. Learn them as the exam uses them, which is as descriptions of venue and counterparty, and don't overinvest.
So learn them well enough to answer and spend the saved hour on Section 2.
Where 33 of your items are waiting, that's where the exam is actually decided.
Professor Castillo, thank you. 2 questions rather than 4 definitions is exactly the version I wanted.
Kai kept pushing for the tell rather than the theory, which is the right instinct in the last week before an exam.
So what actually goes on the index card for this, because market structure is easy to overcomplicate?
2 lines. Primary is the issuer selling and collecting the money. Secondary is everybody else selling to each other while the issuer watches.
Then a third line for the venues. Listed security traded off its exchange is third market. Institution direct to institution is fourth. Both sit underneath secondary. And one small precision worth carrying because a question will exploit it. The exchange itself isn't the secondary market. The exchange is one venue where secondary trading happens. Third and fourth market trades are secondary too, and they never touch it. Venue and category are different axes, and answer choices deliberately blur them.
And the reason to hold it that way rather than as 4 parallel definitions is that the exam asks about consequences, and the consequences all follow from who was selling.
There's a fair counter-argument to how lightly we're treating this, though, and it should be said.
Go on.
Section 1 is 12 items, but market structure also underpins Section 2 and Section 3. If you leave here fuzzy about what a resale is, that fuzziness follows you into 33 items about products and 23 about trading.
Which is a real point, and it changes the advice slightly. Don't overstudy the 4 names. Do make sure the primary and secondary distinction is solid because it's load-bearing later.
So the names are cheap points, and the concept underneath them isn't optional.
One more habit before we close. When a question hands you a scenario rather than a definition, name the 2 parties out loud before you read the answer choices. Who sold and who bought. 9 times in 10, the naming alone eliminates 2 of the 4 options before you've thought about market structure at all.
And it's worth saying which of these actually carries weight later. Nobody builds an options question on the 4th market. Plenty of questions in Section 2 assume you know a new issue from a resale, because that's what decides whether a prospectus was required in the first place. That's the honest split, and I'd rather say it than pretend the whole section is disposable.
Next time we look at the Federal Reserve and the business cycle, and what an exam question about interest rates is really asking. If one thing survives today, make it the first question. Is the issuer on the selling side? Everything about proceeds, new issues, and resales falls out of that one answer.
And your broker trade sends the company nothing.
If you're working toward this exam, subscribing keeps the course arriving in order, and the free practice sets on the site cover the market structure items directly. So before you go, tell me, did you know your trades send the company nothing? Go and write the 2 questions on a card. This is Michael, and I will see you in episode 13.